8, 9, dividend income. So there's basically, when you buy a company's stocks, and this doesn't go for all companies, but some of them, they have two different types of stocks that you have an option to purchase, right? One are just like what we would call growth stocks. You purchase the stock in the hopes that the value will grow and you can make a gain at some point, right? Another type that people like to put in their portfolio are called dividend stocks. Now, they may grow or not. You could also get a capital gain from them. But the company, every so often, will pay the stockholder cash in the form of a dividend. Like if they make a decent enough profit, they share that with the owners of the company, right? You're holding these stocks, and if it's dividend-paying stock, they pay you some money if they make a profit. And usually they'll do that maybe like once a year, or maybe some companies do it once a quarter or twice a year or something like that. And they don't have to, they're not under any obligation, right? So what they do is they make a profit, the board of directors votes on whether or not to pay out a dividend and how much it will be for each share. So the two types of stocks that you can purchase are common stock, okay, and that would be more like the growth type. You're buying for the growth of it versus preferred stock. And this would be, you know, for an income. You know, especially if you want to retire and you want your whole portfolio to, you don't want to have to sell everything off to, right? You want to keep it in portfolio, making the gains, but you can also get some income if it's part of your portfolio's dividend-paying stocks. Okay? And they have what's called a yield, right? So the yield has to do with the percentage of the dividend that they pay you, right? And it's important to know what the yield usually is on these dividend paying before you buy it, right? Like you might want to, if you're looking at dividend paying stocks, and you have, you know, one company has historically had a dividend yield of 0.5%, and another company pays out a yield generally of maybe 5%. Which one would you be more likely to put in your portfolio? The 5%, right? Okay, all else being equal, right? Maybe there's some more risk involved with that, right? And that's another decision. But I think we can just look at a couple of examples here. Let's go over to example 1. Charlie, read example 1, would you please? All right, Tim.
Roberta is considering purchasing a common stock that pays an annual dividend of $2.13 per share. If she purchases 700 shares for $45.16 per share, what would her quarterly income be?
That's pretty simple, right? Do we need to know what the value of the share is to get the income from it, from the dividend? I don't think so either. So what should we do here? Yeah, there's 700 shares, and the company is paying $2.13 a dividend for every share, right? I believe that multiplies out to $14.91 annually, right? But they didn't ask for annually, did they? Do you guys know what quarterly means? How often is quarterly? 4 times a year. How many months is that? Yeah, 3 months. Right? So 3 months is a quarter. Okay. Well, how do we figure out this is quarterly? Just that, exactly right. So 1491 divided by 4. What does that give you? 372.75. Right? Quarterly. All right. Any issues with that? It's kind of a simple example, right? I don't think we need to check on that. It's so simple, you guys. But if you got confused, I hate to claim that it was really simple, and then you're afraid to say you're confused. But if you are, say something. Okay. Now let's go to example 2. Dylan, read example 2, would you?
I don't know how to say that name. Owns 2,000 shares of the corporation that pays quarterly dividends of 51 cents per share. How much does she expect to receive in a year from business?
No, so I guess we're kind of going the other way, right? So we need to figure out what the quarterly amount is and then do what? Yeah. So how many shares does she have? 2,000. What's the dividend per share? 51 cents. And that should come to, what is it? I'm losing my place. 1,020 annually? No, this is quarterly. I'm sorry. Yeah, that's where they set it up. 1,020 quarterly, every quarter. Well, what do we do to get the annual? What times is not a verb? There you go. So 1,020 times 4 gives you, what is that without a calculator? 4,080, right? Annually. Those are a couple of simple, quick calculations, right? I don't think we need to beat that dead horse anymore. But let's talk about dividend yield, okay? Dividend yield is just a percentage, right? You know how to calculate percentages, don't you? Carly, how do you calculate percentage? Well, that's percent change, yeah, right. But just part over times 100, right? So we'll modify it slightly for dividend yield. We'll be more specific about what's the part and what's the whole. So dividend yield, you need to know how to do this. Okay, that's going to be the dividend divided by the stock price times 100, right? Part dividend divided by stock price times 100. Simple enough. And you get a percent, as you might guess. Okay, whoops. There we go. So let's try example 3 then. Simone, read example 3, would you please?
Person owns common stock with access to dividends. The annual dividend is $1.40. The current price is $57.40 per share. What is the yield of the stock to the nearest 10%?
Okay, so the dividend yield, what are we going to do here? Yeah, give me the numbers. $1.40 divided by its current value, 57, what is it? 40 times 100. And you can push buttons, you should get about 2.4%. So that's the yield for particular dividend paying stocks. Now, just to clarify, at the beginning I said that the preferred stocks for the dividend paying and common stocks not so much. To clarify, common stockholders can get dividends too, but it's preferred stockholders always get dividends first, right? And if there's enough, then common stockholders of that company get it. So some of these examples are saying they own common stocks to get the dividend, and they're like second tier. There's a reason why they call the other ones preferred, because they're the first ones, right? And then if they have enough earnings, they'll go ahead and pay the common stockholders dividend. So, all right. I don't think we need to do a check on it. Any confusion about that one? Mercedes, walk us through example 4, would you?
Yes. All right. 1 share of BPO preferred stock pays an annual dividend of $1.20. Today, BPO closed at $34.50 with a net change of 50 cents.
Well, how much? What is it?
$0.50.
Okay.
No, it wasn't, no. Well, how much was the nifty?
Negative.
Yes. You're off by a full dollar. Okay,
Yeah.
all right. Are you officially humiliated now?
Yeah.
Okay, well, that's what two learning takes place.
Struggling to. What was the stock's yield at yesterday's closing?
At yesterday's price, right? So we gotta find yesterday's closing price. How do we do that? The previous close. If it was down 50 cents from that previous close, what do we do? Add it, right? So was it 34.50 plus the 50 cents? I swear to God, if I see anybody's finger on a button. $35, right? So that's the previous close, and now we can get the yield on that, right? So what do we do? What do we divide? $1.20 divided by that 35 times 100, and 3.4%. Not very complicated, is it? Okay. Example 5. So, any questions on this one? Right. Remember, when you find the previous close, you have to do the opposite of what it, whether it was up or down. You all understand that, right?
Yes.
Yes. Carly, example 5, would you?
The stock paid an annual dividend of $2.14. Stock split 2 for 1. What's the annual dividend after the split?
We got a stock. Oh, so we got a stock split. We just learned about that. So we can think about this one a little bit, right? Stock split 2 for 1. What is the annual dividend? So if it's split 2 for 1, how many shares are out there now as compared to previously?
Half.
2 they give you for 1. Double.
I mix them up. How am I supposed to know?
Well, it's a 2 for 1 split. Think of it. Just think like common language, right? You get 2 for every 1 you have.
But how do I not know that, I'm giving them 1 and I'm giving 2 or?
You
They're
do know
getting
that.
2.
business. No. Okay. All right. So it's from the perspective of the company. Think of it that way. They're giving you 2 for 1.
Oh, okay.
That's not a decision that you would ever make, if that helps, right? To keep it straight, the company's going to make the decision. So it's from their perspective, they're going to issue 2 for every 1. Okay? All right, so the annual yield after the split. Okay, $2.14. There's twice as many shares. Well, no, they don't want the annual yield, the annual dividend, I'm sorry. Well, that's not too hard, is it? What do we do? If it was a 2 for 1 split, the number of shares gets doubled. What happens to the price side of it? By half, right? Yeah. Okay. So what are we going to do here to find the dividend? Yeah. Right. Divided by 2. We're multiplied by a half. The B over A from yesterday, right? So we need to take our half of the $2.14. See, none of this is really complicated, is it? It's going to equal what, $1.07 per share. Not pre-share, per share. Right? So not only will the value of the stock be divided into the dividends that go to each one will be cut in half as well, right? Otherwise, it'd be twice as much dividends. Make sense? All right. Let's try the check on this one. Slightly different stock split. Read that over. what's the split in this one? So it's a 3, 4, 2, or 3 halves split. So what are we going to multiply by to get the new dividend? No. You're getting 3, what's 3 divided by 2? 1.5. You get 1.5 shares for a point, right? So instead of, to get the money side, we're not multiplying by 3 over 2. What are we going to multiply by? 2 over 3. So if the number of shares is increased by 3 halves, the value is decreased by 2/3. So multiply by 2/3. So you get times, was it 210? $1.40 per share. After that split. Okay. Any questions on dividends and dividend yield? Who gets dividends and who might not? Right. And try not to be confused about how to work the stock split, right? So if you're talking about the new number of shares, you multiply directly by the ratio they give you, right? When you go to find out the new value, what do you have to do with that ratio? Get the reciprocal and multiply, right? Because they're inverses of each other, right? More shares, less value, right? One goes up, the other goes down. They're inverses. Okay? They're indirectly proportional. All right, so now we're going to go on to corporate bonds here. So we already kind of know that one way a company can raise money for whatever project or things they need to do is to issue stocks, right? Ownership in their company. And people will buy these stocks at the initial public offering, and the company gets a lot of money, and they can do what they need to do. Now, what's the downside for the company when they go public and make themselves a public corporation? What are they giving up? Control of it, right? So now, instead of, like, if I was a company, now instead of me just being the only owner, suddenly, oh, you guys own this with me, and, right? And so you're part of the decision-making process at some point, right? Like voting, whatnot, okay? So I can't just unilaterally make decisions now. Certain things have to go to the shareholder for a vote. So I give up control. But when you guys pay me for these stocks in my company, what do I owe you after that? Do I have to repay the money you gave me? No, I don't have to repay you anything. You know, unless it's a dividend stock, and I'm obligated to pay dividends, right? But after that, my only obligation, and this is actually a very important obligation, it's a fiduciary obligation to run the company well such that it makes a profit and your shareholder value gets optimized. Okay? That is my obligation as a corporation. It's to the shareholders to make sure the value of their shares doesn't tank. Okay? So I have to make good decisions. Right? And that's also why you're involved in the voting in certain decisions. Okay? Now, another way a company can raise money is through corporate bonds. Anybody ever heard of a bond? I don't mean James Bond. Okay. Corporate bonds. Anybody's grandmother ever buy him like a treasury bill or something at the bank? You know, for maybe like $100. And then you hold on to it for 10 years, and then you can go cash it out at that particular maturity date. Maybe you get $150, something like that. Yeah, okay, all right. So when that bond matured, you go cash. It's worth more than 100. So what it actually, I scratch that the way that. So if it's like a government issue bond, he probably paid $50 for it, and then when you cash it in at a certain date, you'll get the 100. Okay. So when you cash in, it's probably $400. Yeah, right. And so that's a way the governments do that. And you've heard of T-bills, T-bonds, treasury bonds, and stuff like that. And there's municipal bonds, like, you know, I don't know if the Village of Waverly has ever done that. But that's a way to bring money in. But if it's a bond, it's like the company actually taking a loan out from you. And so then what do they have to do? pay it back with interest, right? Right, so that's the downside to it. But I'm not raising money now by selling you stocks and ownership. I'm raising money by borrowing money from you to pay you back. What's the advantage?
Not money.
Okay, in both cases, I get money when I issue the stock and the bonds. But what's the advantage to me issuing bonds to you guys rather than stock? What do you get? What was the disadvantage for me issuing stock to me? I'm no longer what? The sole owner of the company. If I issue a bond, I'm still the man, all right? I still call all the shots, right? I don't have to check with you about anything. That's not the agreement. I just have to pay you back at some future date, okay? And they'll come with a maturity, right? So if I issue stocks, I'm giving up control of the company, but then I owe you nothing. If I issue bonds, I keep control, but then I owe you some money, right? So companies have to decide, you know, they sit down with their accountants and figure out what's the best way to raise some capital here. So corporate bonds, what they are is it's corporate debt. And it's paid back at some maturity date in the future, right? It's corporate debt paid at some maturity date. And that could be, depends, you know, it could be a 1-year maturity date, could be 5 years, could be a 10-year maturity, right? You have to hold it. But let me ask you this. If I was to borrow money from you by issuing you guys bonds, right, and it was a 1-year bond, what do you think about the interest rates of a 1-year bond versus if I issued one that matured in 10 years to you? What would you demand? You'd want a higher interest rate for the longer term, wouldn't you? Right, and make more. I got to wait this much longer. I'm going to need the interest rate to be higher for me to buy that bond, right? If it's a year, a little bit low. Okay. Some maturity date at some interest rate. Okay. So they can raise money without issuing stocks. We talked about that, right? Now, companies also have what's called a bond rating, okay? And there are other companies out there that evaluate a company's ability to pay back the interest and principal on their bonds because they're borrowing money. So they're like a credit score for companies. You guys are familiar with the credit score, right? Your FICO and all that, maybe? Remember that stuff? You see that on TV all the time. Where's the credit score? Yeah, right. So corporations kind of have that too, but there's other companies like Moody's will rate companies' bonds, like how risky are they, or how well do they pay them back, that kind of thing. So there are bond ratings. Okay, it's like a credit score. So they can go anywhere from like triple A to A to single A. Right, triple A would be the best stellar rating, right? There's almost no risk to loaning this company money in the form of buying a bond, right? They will pay it back if it's triple A, okay? If they see a little bit of risk, maybe there's something on the horizon that's not good, they'll lower it down to double A, and then maybe down to A, right? So it's a little like minor league baseball, isn't it? Yeah. And then, well, maybe this company's a triple B, right? And then BB. You get the idea? And B, on and on and on, down to C or D, right? If Moody's or S&P rates your bonds at C or D, you're not in good shape, right? Okay, let's say a company with a D bond rating wants to issue bonds. Why? What would compel you to purchase their bond if you think there's a high risk of it not being paid back? What would you require? A higher interest rate, more risk, right? So your credit card and all that, why is that important, right? Because if you're going to borrow money from a bank the bank sets an interest rate based on your risk of defaulting on the loan. If they see you have a high, if they see in your credit history where you've been late with payments, or you went into bankruptcy or something like that, they might not give you a loan at all, or if they do, it'll be at a much higher rate. Because they'll need a higher return to offset the risk. Does that make sense? And you would too, right? Now down here, these are, if you ever heard the term junk bonds, that's what these are, okay? Why would people buy junk bonds? We just talked about it. Why would you buy that junk bond? The potential for a really high return, right? You know, they might be like a AAA rated bond, might have an interest rate repayment of, I don't know, 1.5%, right? Yeah, but if you were buying a D-rated junk bond, you're probably up at like 22% or more, right? Which would compel you to be more likely to purchase that. Okay, there's a lot of risk there, but there's also the opportunity for quite a bit more return, right? So there goes that my portfolio, okay? So that's, and they're also, by the way, these bonds like stocks are traded on the secondary market, right? Once you purchase a bond, you don't have to hold, right? You can sell it to someone else, okay? And a quick rundown on how this works, I won't write it all down. So let's say that a company issues some bonds, and they issue the current bonds at like a 1% rate, right? And then a couple of years later, generally interest rates in the country go up, and they issue more bonds at a 2% rate. What do you think happens to the face value of the bonds that were issued at 1%? If you wanted to sell it to somebody, knowing that 2% bonds are now out. Well, they will. It would be low, right? So they all have a face value, like $100, right? $100 bond, right? So if new bonds now have a higher interest rate, if you want to sell this $100 bond at the lower rate to somebody, maybe they're only going to pay $95 or $90. You get the idea? Or the other way around, right? If new bonds are coming out with a lower interest rate, and you got some that are at 5%, right? Somebody might pay $110 for that $100 bond because it's got the higher return. Does that make sense? Okay, so these things are, right, so when overall interest rates go up, the value of the bonds that were already out there go down when you're trading it on the market, and vice versa. Hopefully didn't confuse you there. I think maybe you get the idea.
It's just an idea of bottom.
Yeah. But it gets more complex, right? Especially when you can trade these things on the open market, right? Yeah. So let's look at example 6 then. And by the way, they generally use simple interest. You guys remember simple interest? Let me just put this in here. The simple interest formula. I equals PRT. Does that sound familiar? I know you've done that. I equals principal times rate times time in years. You remember compound interest? I know you've done it. Compound. So these are formulas you really need to know. So that's the amount equals principal times 1 plus the rate over n to the nt. I know that's got to look somewhat familiar. N is just like the number of compounding periods. Just compounded monthly for the 12 intervals ends. And do you remember continuous compounding? Like an infinite number of compounding periods? Continuous compounding. And by the way, if you don't have these committed to memory, these are formulas you probably want to have somewhere where you can access them frequently throughout the course here. Huh? Like where?
Yeah.
But so, I don't know, for your notebook or back you're gonna get a tattoo maybe?
Bet I won't.
P E to the RT, that PERT thing. These are formulas we'll use quite frequently here and there. Okay? And bonds are usually paid simple interest. So if it's like a 10-year bond, it matures at the end of 10 years. But they usually don't wait for the 10 years to get you some of the interest. So they usually pay each year whatever the interest accrued on that bond each year. All right. Unlike a treasury bond, like the government, they won't pay you anything until that maturity date. Okay. And it's simple interest. They'll use PRT. Doesn't compound, right? Because they're not keeping that interest in on it, right? They're giving it to you. So, example 6. Read that for us, Mercedes, will you?
I bought $5 for the cash corporation. The bond pays 5.7% interest per year. How much does Adam receive in interest each year from his bond?
So they're paying out the simple interest each year, okay, to the bondholder. Well, we're going to use simple interest, right? I equals PRT. P is the principal. So what's the principal in this case? How much? $1,000? Well, I got to put a 1 in there. What's our rate? But now be careful. I know you know this. We can't use 5.7 mathematically here. What do we have to do to it? Divide it by 100, right? Move the decimal twice to the left. So what's the R going to equal? 0.057. It's very important, right? And what is the time in this case? Well, the question was, how much do you make in a year? Every single year. Just 1, right? You with me? This is important. You got to convert that rate to 100. Divide it by 100. I don't know what I just said.
Just so I know.
This is 5% means out of 100 per, like each and every century, 100% means out of 100. So 5.7 basically here. Right? So to use it, it's all like to display it as information. It's helpful to have it as 5.7%, like in the bank window, right? But to mathematically operate, you've got to use 0.057 percent. It means 5. So okay, it means 5.7 per every 100. What is it? Okay, just an aside here.
That is so cool.
5.7%, right? That means 5.7 per every 100. And what does per mean in math? What operation does per mean? Division. This then means 5.7 per 100. Hey, I'm dividing by 100. Got it? And that means 0.057.
That's all you're using for the word percent?
Mm-hmm. Per meaning for each and every. It's Latin. Cent meaning 100.
I'm not.
How many cents are in a dollar? How many years in a century?
Carly, I know what you read today.
Okay. So let's go back. So interest equals 1,000 times 0.057 times 1. We don't really need to put that there. So what does that mean? How much? $57 each year. Did they ask to follow up on that question?
Check.
Yeah. Well, let's.
Rachel Hoffman, please, up at high school office.
Let's just add to that there. Now, what did he buy it for? $1,000, and they're paying $1,057 if it's a 1-year maturity, okay? Understand that? All right, you guys try the check with this one. Maybe. Check says, now he's holding it for 11 years. Only one thing changes in our formula, doesn't it? What changes? How much interest does he make? I think you got a decimal off there. What does he make in interest altogether? You put 1.1 for the year? They said 11 years.
Yeah, so minus the,
All right, we'll let that one go. What do we got? So $627. So if that was what it got paid to maturity, right? They would pay him a total of how much? They got to pay back the principal and the interest. So how much are they paying back? So they're paying $1,627 at maturity. Sure, why not? All right, does anybody have any questions on this? We're not going to do, there's no other example.
We're not getting bond. The bond store.
Yeah,